welcome to this special two-part series on smart money moves for new investors presented by FreeCharge. I'm Ridu Bhandari. Today, we are going to be talking about top 3 investment lessons that COVID-19 has taught us. It's true that some of life's best lessons are learned through our most difficult experiences. During the course of 2020, we've seen that the economy has weakened. We've seen markets crashing. We've seen people losing jobs. All in all, the ongoing pandemic has somewhat caught us unawares and left many of us in financial jeopardy. So I have two experts who will sort of chart out the future for us today and also extract some of the top lessons, financial lessons that COVID-19 has taught us. Let me welcome Shruti Agarwal, CFA and co-founder of CAGR Funds, and Suparna Bhandari, Head of Product Financial Services at FreeCharge. Welcome,
Hi,
ladies.
Madhu.
Thank you very much for joining us here today. Well, let me begin with the macro trends then. Now, Shruti, have you seen any significant shifts in the investing landscape during the course of the pandemic?
Yeah, so Mridu, I think last year was 1 year when we saw the bottom and the high of the market all in the same year. And one of the shifts that we have been observing is a lot more interest coming into the equity markets. So earlier, say a couple of years back, every time there was a correction, we used to see the correction used to last for a really long period of time. But this time, the correction was very, very short lived. That was primarily because there was so much of interest in the Indian equity markets, so much of money coming into the markets. There are so many first time investors willing to bet on equity that I think that's one significant shift that we are seeing. Also, what we have seen is that with interest rates declining so much in the last 12 to 18 months, interests have really shifted from fixed deposits to equity markets. So those are two key trends that we have identified.
All right. So equity markets gaining interest there. Suparna, every crisis brings with it some opportunities as well. What would you say are the big financial opportunities that a crisis like this has brought to light?
So multiple things. One, digital economy has suddenly got a boost. I mean, in the pandemic, we had people who had first made their first digital payment, but there was still a section of society which was not, doing things digitally. Suddenly, from everything from a bank account opening to buying stocks to buying dhania, everything is now online. I mean, my own mom, who has not been digitally savvy, has been knowing only grocery shopping through these, big baskets and grofers, and that's extraordinary. That's an opportunity that we suddenly saw, that people are ready to adopt things digitally, and that's where uh, apps like FreeCharge and other investment apps, those are the ones that have an opportunity there, that we can reach out to consumers like we've reached never before. So I think that's one of the biggest things that we have seen through the pandemic.
Right. Okay. Absolutely. Digital transformation, digital adoption. Experts are also saying that some of these black swan events or gray rhino, as we are calling it now, will occur from time to time. So, Suparna, what do you think are some of the changes to our portfolio that we can make, in order to be better prepared for some of these large events that may be rare but are also likely to have a huge impact?
Certainly, youngsters are very aware of taking a term insurance and a health insurance. Uh, there has been, industry has reported that there has been a 40% increase in uh, the term insurance premium in less than 35-year-olds. I mean, that's extraordinary. The second thing that we've seen is that people are suddenly so aware that their families are not protected, and health insurance is something that everybody has taken. The third thing I think that we've seen is so many new investors, like 24 lakh new investors in just the first quarter of lockdown, who have entered the stock market. This has never happened before, because the equities were available at a discount, and suddenly everybody wanted to kind of jump in. Uh, and of course, the most important thing that this pandemic has kind of made us aware of is that how unprepared most of us are when it comes to these emergencies. There have been job losses, there have been pay cuts, and suddenly people found themselves exposed that they did not have emergency funds to take care of these things. So this has kind of inculcated a habit of probably putting more money in fixed deposits, putting more money in debt funds, so that they're kind of cushioned against these emergencies. People are more aware of making these savings. Their spendings have reduced because most of the spending has been on the core needs like grocery, and probably electricity, food, etc. The other spending has absolutely reduced, and people have started kind of uh, diver, you know, they started putting those funds now in savings options, and I think that's something that probably the impact of pandemic is going to take some time to kind of wash away, and people will probably take some time to kind of again indulge in those foreign holidays or luxury experiences. People are very saving focused now.
So, as we are closing this conversation, what is the top investment tip or the lesson from the pandemic that you'd like to leave our viewers with?
Like I said, just major two or three things. Be better prepared for emergency. I mean, have a pool of emergency funds always available for you. Second, protect your savings. Buy insurance, buy term insurance, buy health insurance. You should always be prepared. Anything can happen at any point of time. And third, uh, if you have not started investing already, you should start investing. If you're not somebody who likes to invest in equities or is not conversant with the whole terminologies or the whole equity gyan, I think mutual funds is the right platform for you to start investing, and you should start making a sip right away, irrespective of where the market is, because every time is a good time to invest in a sip.
So, one of the investment vehicles that's gained popularity in recent years is that of mutual funds. Now, the big question is, should you be buying mutual funds at this point in time, or should you be changing your mutual funds? Any tips from the two of you? Shruti, why don't you go first?
I think mutual funds should be changed only when there is a fundamental reason to change them. For example, I've seen investors wanting to hop out of their mutual funds just because they haven't given as high a return as their other funds in the portfolio. I think that's not the right approach. If there is a fundamental change, like a portfolio pick that doesn't suit you as an investor, or a fund manager change which becomes a risk event for you, I think that's when mutual funds need to be changed. Whether it's the right time to buy mutual funds, I think for people who want to invest a lump sum amount, they could be a little cautious. But for a long term investor who's willing to stay invested for more than 10 years, is happy to go through the SIP route, I don't think the market levels matter, because SIPs eventually erode out the volatility that the market presents you with. So for lump sum, maybe we can have a staggered approach, but for SIPs, I think there's no problem.
While we are talking of mutual funds, there are hybrid funds that are also becoming extremely popular with investors today. Shruti, what are the merits of investing in hybrid funds, and what to keep in mind, how to select one?
So even within the hybrid fund category, we have funds which are aggressive hybrid funds and conservative hybrid funds. So the aggressive hybrid funds have a mandate that minimum 65% of their corpus needs to be in equity. So what a hybrid fund essentially does is reduces the risk on your portfolio, because the entire thing may not be invested in equity. So it's suitable for, say, first time investors who are entering equity for the first time, and it is suitable for people who don't have the appetite to face a lot of volatility in the market. So perhaps a hybrid fund will go down lesser than a pure large cap fund or a mid cap fund, and that's how it's suitable for people who don't want to take too much risk and are first time investors.
Right, right. Also, there is often a debate between debt funds, equity funds, how much to invest in both, which is more optimal for the long-term wealth creation. What are your tips for that, Suparna? Why don't you start?
If you're looking for a long-term investment, like probably investing for your child's education, you should pick up an equity-based fund, ideally. And if there's a short-term sort of an investment need that you have, debt fund is what really works. I'll give an example from my personal life. I have a 5-year-old, and I know that I want to send him abroad when he turns 18, and I know that an education which is costing 1 crore right now would be like far more. And a debt fund is something which cannot even beat inflation if I invest my money in debt fund to fund my son's education. So equity fund is something which historically has given returns between 12 to 18%, and that's essentially what you should invest in when you're looking at such sort of a goal. Otherwise, for anything for till like a 2 or 3 year period, goal that you have, I think debt funds work great.
So as we close the conversation, any top investment tip or lesson you want to leave our viewers with? Suparna, Shruti? Who?
I think
Suparna.
I think the only thing that I would want to tell people, uh, every time is the right time to invest in mutual funds. And even if the market is at an all-time high right now, it's a great opportunity to start their first investment, because over the years the market will average out. But 10,000 a month for 20 years has the potential of becoming 2 crores. That's the power of SIP. So they should start making the investments right away.
Right, absolutely. Power of compounding being pointed out there by Suparna. Shruti, what's your top investment lesson?
I have too many tips to provide. What I've seen is that in the kind of rally that we are seeing right now, it's a unidirectional rally over the last 7 to 8 months. I think what a lot of people start perceiving is that they are willing to bet everything on this market because, well, it's giving, say, 25-30% return. So the FOMO really creeps in. And I've seen people really putting their emergency funds into the equity market because they think that they will be able to make that kind of return in 3 months. I think that's not something that should be done. So having an emergency fund in place is extremely important. Having insurance in place is extremely important. And then having your investments in place is the right approach. One should not get swayed by market corrections and market rallies, because that really gives a false impression of what kind of risk you are willing to take. It really misleads your risk appetite.
All right. So power of compounding multiplied with a lot of patience should result in good wealth creation over a long period of time. Thank you very much, ladies, for sharing those very, very valuable and knowledgeable insights. And I hope these investment tips will help you protect and grow your money. Thank you very much for joining us. Goodbye.
Thank you so much. Goodbye.